Imagine waking up one morning and realizing that the future of artificial intelligence isn't being built in some distant Silicon Valley lab. It's being powered by sprawling complexes the size of small cities, each one consuming electricity like an entire metropolis, and costing tens of billions of dollars to construct. Welcome to the trillion-dollar world of AI data centers. Today, we're diving deep into the economics of owning one. Not the hype, not the headlines, but the real numbers. Who pours in the money, who walks away with the profits, and what this massive build-out means for all of us, watching from the sidelines. If you've ever wondered whether the AI revolution is as bulletproof as it sounds, or if it's creating winners and losers in ways most people don't see, this video is for you. Stick around, because by the end, you'll understand the hidden math that could reshape economies, investments, and even your own financial future. And remember, this is for educational purposes only, not financial advice. Always do your own research. Let's start with the scale that blows minds. In 2026, the biggest tech companies, think Microsoft, Google, Amazon, Meta, are projected to spend hundreds of billions on data centers alone. Some forecasts put the global AI-related infrastructure investment in the trillions over the next few years. 1 gigawatt-scale AI data center, a facility powerful enough to train the next generation of models, can require upfront capital expenditures of around $38 billion. That's according to detailed modeling from Epoch AI. To put that in perspective, that's more than the GDP of some small countries, all sunk into steel, servers, cooling systems, and power infrastructure before a single AI query even runs. Why so expensive? Break it down. Servers, and the specialized hardware like those high-end GPUs from NVIDIA, often account for about 60% of the total cost of ownership. We're talking racks upon racks of chips that guzzle power and generate immense heat. Then there's the facility itself: land, buildings, redundant power systems for reliability, and massive cooling setups, because these machines run hot, 24/7. Epoch AI's analysis shows that for a 1 gigawatt setup, you're looking at roughly $38 billion in capex and hundreds of millions annually in operating expenses, with energy being a major but not dominant piece once annualized. Think about it this way. If you were to own something like this, not as an individual, of course, but through investment in the companies building them, what are you really buying? A ticket to the AI gold rush? Or a massively complex machine with enormous ongoing costs? The total cost of ownership, when you spread capex over the asset's life and add opex, comes out to around $8.5 billion per year for that 1 gigawatt facility. Servers dominate, but power, networking, labor, and maintenance all add up. This isn't a simple warehouse. It's a living, breathing economic engine that demands constant fuel, literally, electricity and expertise. Now, let's zoom out to the bigger picture. Industry analysts project that the U.S. alone could see data center capacity expand by 200 gigawatts or more in the coming years. Using benchmarks from Columbia Business School research, a 200 megawatt AI training campus might cost over $8 billion total, with compute hardware making up the lion's share. Scale that up, and we're talking investments that rival entire sectors of the economy. Morgan Stanley and other firms have floated numbers in the hundreds of billions annually for hyperscalers. It's not just building, it's a race to secure power, land, and chips before competitors do. But here's where the curiosity really kicks in. Who actually profits from all this? The answer isn't as straightforward as the companies building the future. Let's look at the players. First, the hyperscalers themselves: Amazon Web Services, Microsoft Azure, Google Cloud. They're pouring in the cash because AI demand is exploding. Training models like the successors to GPT requires unprecedented compute. They rent out capacity or use it internally, generating revenue from enterprise customers, paying for AI services, cloud storage, and inference. Yet, payback periods can be long, and utilization rates matter enormously. If your data center isn't running near capacity, those billions sit idle. Then there are the chip makers, especially NVIDIA. Their GPUs are the picks and shovels in this gold rush. Demand has driven their valuations sky high, but they face competition. and the risk that newer architectures make current hardware obsolete faster than expected. Research Affiliates highlights how rapid depreciation in AI hardware means a big chunk of today's capex is replacement spending, not pure expansion. Under conservative assumptions, net new capital formation might be only a fraction of the headline trillions. Energy companies and utilities are another winner in the short term. These data centers are power hogs. A single large facility can consume as much electricity as hundreds of thousands of homes. In places like Virginia or Texas, where clusters are growing, utilities are scrambling to build new generation and transmission. Some analysts from the IEA and others note that every billion in data center investment can drive significant related spending in power infrastructure, sometimes 20% or more funneled back into grids. But challenges abound. Interconnection queues are long, permitting takes time, and in some regions, there's pushback over water use for cooling or strain on local grids. Private equity, REITs like Digital Realty or Equinix, and specialized developers also play key roles. They build and lease facilities, often with long-term contracts from the big tech firms. Yields in the 7–12% range are discussed in industry reports, but risks include construction delays, energy price volatility, and regulatory hurdles. Columbia researchers point out that the shift to AI-specific designs changes the cost structure dramatically, more emphasis on power and cooling than traditional data centers. So, is this a guaranteed boom for owners? Not quite. Let's talk risks and realities that most headlines skip. First, economic obsolescence. AI hardware advances rapidly. A server bought today might be outdated in 2 to 3 years, meaning heavy depreciation. Research Affiliates modeling shows that under 2-year life assumptions, net capital accumulation from 2026's massive spend could be far lower than gross figures suggest. You're constantly reinvesting just to stay competitive. Second, energy constraints. Power isn't infinite or cheap everywhere. Electricity costs, PUE, power usage effectiveness, and utilization rates directly hit the bottom line. Epoch AI estimates put energy as a notable but manageable part of OpEx. Yet in a world of rising demand, prices could spike. Some projections warn of bottlenecks that could slow the build-out or raise costs unexpectedly. Third, the revenue side. Hyperscalers generate money by selling AI capabilities, training, inference, enterprise tools. But competition is fierce. Pricing for inference is dropping in some areas, and not every model delivers immediate ROI for customers. Bain and JP Morgan analyses have flagged scenarios where revenues might fall short of the investment needed for sustained high returns. If customers balk at high prices or open-source alternatives gain ground, the economics shift. Fourth, broader market risks. This build-out represents a huge bet, potentially 2 to 3% of U.S. GDP annually at peak. History shows massive capex waves, like telecom in the late 90s, can lead to overcapacity and painful corrections. While AI feels different because of real demand signals, the scale invites scrutiny. What happens if adoption slows or efficiency gains? Better algorithms needing less compute arrive faster than expected. Despite these challenges, there are clear paths to profit for the smart players. High utilization, long-term contracts, vertical integration, owning power assets, or chip design, and geographic advantages. Access to cheap, renewable energy or friendly regulations make a difference. Some smaller or specialized operators in niche markets might find outsized returns by focusing on inference or edge computing rather than massive training clusters. Let's bring this back to you, the viewer. Why should any of this matter if you're not a billionaire building data centers? Because this boom ripples everywhere. It drives demand for electricity, which affects your utility bills. It fuels innovation that could change jobs, industries, and investments. If you're in tech, real estate, energy, or even just investing in the stock market, understanding these economics helps you spot opportunities and risks. The companies profiting most might be the ones quietly supplying the infrastructure, not always the flashiest AI names. Consider opportunity cost on a personal level too. The capital flooding into data centers isn't available for other things: housing, infrastructure, or your own investments. But it also creates jobs in construction, engineering, and maintenance. It's a reminder that big technological shifts are never just about the shiny product. They're about the unseen economic machinery underneath. As we wrap up, the trillion-dollar economics of AI data centers reveal a story of immense ambition and complex trade-offs. Servers and power dominate costs. Hyperscalers and chip leaders capture much of the upside, but risks around depreciation, energy, and overbuild are real. The true winners will be those who manage utilization, secure power wisely, and adapt to rapid change. What do you think is this? The foundation of a new industrial revolution or a high-stakes gamble? Drop your thoughts in the comments, and if you found this breakdown valuable, like and subscribe for more deep dives into the forces shaping our economy. Turn on notifications so you don't miss the next one. Thanks for watching, and I'll see you in the next video.